All right. Well, welcome back, everyone, to our monthly roundtable. It feels like it's been too long. We are ready to talk real estate, almost coast to coast, not quite. We have Steve Saretsky in Vancouver. Hi, Steve.
Good to be back. I got some better lighting this time.
Everyone's so harsh. Steve is with Oaken Realty in Vancouver. He's a very active realtor and analyst of the market there. And John, you are with me based in Toronto at Velocity Realty. How are you doing?
Very good, very good.
And John, again, is a very active broker and an analyst of the market. So we've got you guys all together. We left with the feeling that things are going to be a bit slow. I'm not sure. I feel like the mood's a little different here. John, why don't we start with Toronto? It's showing a little more life, I think, the market than we expected. You recently tweeted that all the houses and condos that were sitting on the market in November and December with few showings and low ball offers are now selling, in some cases with multiple offers. All the houses and condos?
Yeah, I mean, it's fun. The Twitter people did not like that. I mean, I love that everyone picked up on that, and I got trolled a lot for suggesting all the houses. I mean, obviously not all are.
We've discussed restraint
unbelievable. I mean, I find it unbelievable the things that concern people and they invest the time to even write comments about. But anyhow, I mean, the funny thing was obviously not all, but I mean, it is what we're seeing. A lot of places on the ground that have been on the market for a while are selling. I mean, around that time, I got someone who's actually a home seller kind of share their anecdote with me because I like hearing people's stories. And, he told me he had his condo on the market in November. They priced it well. They were getting very few showings. They were only getting lowball offers, like 10% below their asking price. And they eventually just took it off the market and with the plan to relist it, in the new year. And they were planning on February. Their agent called them, said, no, let's list it right away. In January, it's busy. So they relisted his condo in January. They were considering reducing the price, but then just decided to stick with the same price they had in November. And he said within 3 days, they had more than a dozen showings, and then they had 3 offers, and it sold for 5% over asking. Right. Which is a wild story because, this is a condo. Obviously, if you kind of bid on it in December, you would have bought it for under asking, and literally a month later, he's getting a ton of showings, multiple offers, selling for over asking. And obviously not every house or condo is selling for over asking, but it just kind of shows you the shift in the market and the mindset, I mean, I don't know I think Steve and I probably were talking about like back in the fall that some people are just taking their places off the market with exactly this intent. It's like, I'm not getting showings. I'm just going to list it in the fall. And everyone on Twitter, where we're pretty active, is like, that's a terrible move. Who's the realtor? Who's advising them? That's the stupidest thing you can do. Prices are obviously going to fall further. And the market doesn't behave the way you think it will sometimes. It was obviously a good bet for a lot of people who did that because we're finding on the ground right now, the market's more competitive than we thought. And I think it's just, even though sales are down, there's just so few listings. So the ones that are kind of coming on the market are selling pretty quickly.
So, John, my understanding is the first thing we saw were more showings, right? Like houses that we're not getting a lot of showings. Nothing had changed with them. Come the new year, all of a sudden there was a lot more.
So here's the thing with January, February, at least in Toronto. I don't know what it's like in Vancouver for Steve, but January, February, March are usually the most competitive periods because this is where people start their search, right? The period when people start to buy in the spring and the period where they're the fewest listings, right? And I think what happened this year, the reason things are busier than in the fall is my instinct is a lot of buyers hit pause last year, right? And said, you know what? I'm going to wait for prices to fall further. And then they waited, and then they waited, and then they waited. And since July, prices haven't fallen. They've been flat. So, if you're the kind of buyer who needs a home, are they just throwing in the towel and saying, okay, let's just buy now because prices haven't moved in 6 months. Rates aren't going to go much higher. Let's just buy a home. And I think this kind of pushed a lot of people who were on the sidelines back into, actively looking at homes again. I think that's partly what's fueling this.
So part of it is a typical cycle. You see demand start up in the new year, listings are normally low. And you're thinking this is more of a delayed situation. This is not an excess of demand or more demand entering the market.
I don't think it's so much net new buyers. Like obviously there are some. I think it's like people who had hit pause who are jumping back in. That's kind of fueling this. And
was this before or after the debate broke out about whether the Bank of Canada was done with the rate increases?
Right around the time. Yeah, right around.
I got the sense it was before the showings and the number of viewings on properties picked up before.
Yeah, okay, possibly. Yeah, exactly. Because the bank hike was at the end of the month. Yeah.
Right. So it's not just related to some of the exuberance, which we're going to be talking about, or this hope that maybe we've seen the end of those rises. It seems like buyers came back like they normally do in the new year, and maybe there was just more of them because more of them had been sitting on the sidelines than usual. Exactly. Steve, what are you feeling in Vancouver? Are you seeing these same trends or something different?
Yeah, no, it's pretty similar as it tends to be. I think that, if you look at sales, it was the fewest number of sales for January since 2009. It was the fewest number of new listings since January of 2004. So you basically had like a 20-year low in new listings. And I think that's really, to John's point, is kind of what's causing increased activity at some of these like new listings. We are seeing a lot of like new listings, like a house that just gets listed, it hits the market, that some of those houses are getting, 20, 30 groups through the open house and getting 2 or 3 offers, 4 offers, 5 offers on them, which is crazy, right? Because you're like, wow, like who are the crazy people that are competing in this environment? Everybody expects, the recession, house prices to continue to go lower, but it's like, yeah, I mean, sometimes markets do crazy things. We have to go back and look at the onset of the pandemic, which was like, remember we had all those mortgage deferrals, job layoffs, the world was ending and like people were out competing for houses, right? So it's like, yeah, like the market can be very irrational. And so I think that's kind of, what we've been seeing is like, I think the current levels of inventory coincide with bull markets. Thankfully, demand remains weak. Otherwise, yeah, you would see significantly higher prices. I mean, the current number of active inventory is basically you go back to 2016, you go back to 2006, 2007, you go back to, early days of sort of the depths of the pandemic there. It's like these inventory levels are so tight. And so I think you've had all these people that, again, like to John's point, have been sort of humming and hawing, waiting for prices to come down, waiting for more inventory. And like it hasn't really materialized, at least to their hopes. And so I think there's a little bit of frustration and people have been going back and basically, bidding up stale inventory. So houses that have been on the market for 3 months, you go call the listing agent and say, hey, is this one still available? No, sorry, we got 2 offers on it last week. It's sold. So it's like, really? Like, okay, so that's kind of what's happening. So I think it's really hard to draw any like real conclusions and say, oh, this is a trend, the bear market is over. Like until we get a couple more months of this, until we get some clarity on what's going to happen with inventory, I'm struggling to say that, the worst is behind us.
That's a good point. And one of the concerns that we're hearing in the industry is that this trend is not really showing up in the numbers. So, there was a very interesting tweet from Toronto realtor Daniel Falk, I believe is.
I think it's Foch. I call him Foch. I don't know.
Daniel, please leave us a comment below on how to pronounce your name. But he's very active in the Toronto area, hosts a lot of Twitter spaces. And I had a very interesting comment on Twitter recently. So every good realtor I speak to is saying the same thing, feeling the market heating up, more sales urgency, confidence. But the data doesn't show that. When the market gets bad, people go to the good agents. That's why they're feeling it. Bad agents won't feel it at all. So not controversial at all. But what do you make of this observation? I am curious about that. Is it the good agents are the canary in the coal mine, or are they the only ones getting a little bit of attention in what is still a down market?
This is a tricky one. I mean, I don't like I don't like overly debating stuff with other people in the industry. Like, I don't necessarily agree with Daniel. I think the key takeaway is, and the positive thing is that there are a lot of people looking at different data, right? And I think as a consumer, as a buyer, as a seller, I think it's important to listen to Steve, to me, to Daniel. Everyone has their own interpretation of what is happening. You know, I went to an economics forum recently and the economists didn't agree. You know what I mean? And they're looking at the same data, right? But again, I think this goes down to the fact that people's interpretations of the data are different. People are looking at different directions. And I think that's the same here. Like, certainly when I say I disagree with Daniel, I disagree because all the data I'm looking at is a market that has actually been accelerating over the last 2 weeks of January, right? Like, if we look at how the trends are, inventory has been plummeting. There are way more bidding wars. Like, if we look at the data on a weekly basis, like last week in Toronto is the high, like when we look at the percentage of low-rise homes that sold for more than the asking price, which is kind of a measure of how competitive it is, it's the highest since it's been since July, right? So there are these slight indicators. But to Steve's point, these are just like early signs. Like, it's who knows what the next 2-3 months are going to be like. It's a function of what listings and inventory are like. But certainly, I think the market is more competitive. I kind of see it in the data, but I'm not. You can't make predictions about where it's going, I guess is what I'll say.
I've got two thoughts. I think Dan was right, though, in the fact that if you look at, so last January, for example, inventory levels were slightly lower. So I think we had like record low inventory levels in January. That's why like prices literally went up, I think like 5% for the month of January, right? So inventory levels were actually slightly lower last year, yet sales were like 45% higher. So I agree with his point that like, if demand was like really, really strong and really coming back, like we wouldn't have had the lowest sales since 2009. So, but I do agree with you. Like, yeah, it clearly has picked up, and it's not just a GTA and Vancouver thing. Like, if you talk to even like realtors in the US, the CEO of Redfin was out there the other day putting a big tweet storm together saying that all of their models and their sort of analytics is showing increased activity. Obviously Redfin probably has some of the best analytics given their website traffic. So I think that's number one. I think number two, I think it's always hard to analyze real estate markets on like a week to week basis. I think you can drive yourself insane, right? Like, one of the things that maybe this is leading to the next conversation, but one of the things like I'm really pondering now is, so we're getting a lot of people in the industry coming out and saying the Bank of Canada has done hiking rates. This is the end of the bear market. Prices might even go up this year. But then they're also calling for the Bank of Canada to like cut rates in 2023. And like, I get worried and say, if house prices actually start accelerating from here and multiple offers become entrenched, I think that just gives the Bank of Canada more ammunition to stay higher for longer. Why would you start cutting rates if you're trying to fight inflation and put a dent in demand and consumer spending and the wealth effect? I think the last thing the Bank of Canada wants to see is a real acceleration in the housing market.
Yeah, but rising home prices aren't necessarily going to be the biggest driver of housing inflation, right? It's arguably their interest rates that are having a bigger impact, and the fact that people aren't buying homes and moving to the rental market, pushing rents up 20%, that is actually having a bigger impact. I don't know. I'd be surprised. I don't think there's concerned about housing personally. I think they were concerned about it 2 years ago when they wanted to drive the economy up.
I agree, but I found it interesting because there's been two papers, and you have to take every sort of economic paper with a grain of salt. There is no, like, it's never black and white, but there was two research reports. A bunch of them were tweeted out by Fed officials, or not Fed officials, but the guy that writes in the Wall Street Journal that basically is in the pocket of the Fed, Nick Tiramisu, or whatever his name is. Anyways, so there was one report was saying that I think it was 2/3. They said they estimated that 2/3 of the US CPI inflation increase was result of the wealth effect from rising house prices during the pandemic. So they said 2/3 of all inflation they figured could be derived from the housing boom. And then there was another paper later, like the week after, which suggested that if US house prices had just continued to increase at their normal pace like they did in, say, 2019 versus what happened during the pandemic, there would have been no drop off in labor force participation rates for elderly or boomers that ultimately said, my house went up, I'm going to retire early, call it a day. And so that's obviously what's now driving, companies having to bid for employment and push wages higher. So it's interesting. Like, I think I'm struggling to think that central banks want higher asset prices.
Yeah.
So can I just unpack one thing here?
Sure.
It seems like, we were going to actually talk about some of these, the interesting things that accelerated housing prices have done. So, we've talked about in the past, people spending, taking money out of their HELOCs and investing in other properties. That's one way. Consumer spending can go up. And when we're all stuck at home and your house prices are going up and there's nothing else to do, we all went to Amazon during the pandemic and spent a lot of money on consumer goods. And then Steve's point, which we were going to touch on, and why don't we do it now? Here's a snapshot of a paper that John was tweeting about as well. I believe this comes out of the University of British Columbia, if I'm correct.
Yeah, it was from UBC.
Or did they just tweet that?
Oh, yeah, that's right. The academic Favulakis. You're right.
Yeah.
Yes,
I believe Favulakis and Lee from the University of British Columbia, UBC, but they were studying, as Steve was mentioning, the behavior of labor force participation by older Americans. And they believe that the increase in their own home prices that they were sitting in, resulted in probably their overall retirement and nest eggs looking decent enough for them to leave the labor force earlier than they would have. Did that, and their headline is the Great Resignation was caused by the COVID-19 housing boom. Now, I'm not really sure because I also saw a lot of videos about people just saying, I hate my minimum wage, terrible job, shove it. So I think the Great Resignation seems to be many factors, but I think, Steve, you have a great point. The one thing I get confused about is when bankers are looking at inflation, and I know there's core inflation and then there's a more broad metric. My understanding in Canada is that they look at what it costs to rent a home rather than, like, that's one of the primary ways they look at housing inflation in Canada. Is that correct?
So I think in Canada, they look at the cost of replacement of your shelter. So basically the cost of rebuilding, I suppose, your home, versus the US, I think they look at owner's equivalent rent, which is basically, I think what they do is they survey homeowners and say, what do you think it costs to rent the house that you own? Which
my understanding is, do both kind of do that? They're basically asking, if you didn't own your home and you had to rent, what would the cost of your housing be?
So for owner occupied housing, so we of course, like for rental housing, we look at how rents are changing, but it's the owner occupied housing that we do things different. In the US, Steve's right, for an owner occupied home, they basically say, well, what would this home rent for? And that's what we're going to use for the inflation index. In Canada, they use something that's called like a user cost model, which is basically looking at how the costs to owning change over time. But the biggest cost to owning are interest rates, right? Which is why, like, if you remember, we had this weird dynamic during the boom where prices were exploding. Okay, but like housing inflation was actually plummeting. And I think the Bank of Canada had this chart that actually showed that, right? Like, prices are skyrocketing because inflation or interest rates went to practically to zero. The inflation on housing actually plummeted, and only now it's gone up. And it's gone up, I mean, in part because of higher prices, but mainly because interest rates are through the roof, right?
That was the confusing part. So in Canada, yes, I remember looking at that. Our inflation was driven a lot by supply chain, tie-ups in the beginning, increased demand, and then there was the gas story and the food cost story, which remains really strong in Canada. But for a time there, you're right. The housing wasn't part of it. Now it is. So, so I guess to your point, John, it seems like there's two things. I get Steve's point that this household wealth that we all have drives our spending, drives inflationary pressures because we want to consume, we can consume, maybe we don't even have to work, so labor costs go higher. But on the other hand, the direct measure they use seems to be more tied to the interest rate in Canada, at least. Mm-hmm. So that's a bit strange. I mean, in the US, would you say that's more straightforward, that relationship between housing and other consumables?
Which one? The inflation approach?
The way they measure it, the way that they look at rent rather than what the costs are to own.
It's debatable because the Canadian way actually does measure what it costs you to own a home. The fact is, in many ways, the Canadian approach is actually more realistic. And what people don't get is they look at house prices rising as like a sign that, you know, housing inflation period. That's not the case. Like, inflation's about how much money am I spending out of my pocket for my shelter costs, and how is that changing over time? And the fact is, the Canadian approach is actually more accurate. Our shelter costs plummeted during the boom because interest rates were lower, and now it's becoming more expensive because our mortgages are 5%, not 2%, right? So it's not an indicator. I think that people confuse it. They think about housing inflation as some sort of metric in terms of how much it costs to buy a home, but it's not that. It's how much to carry a home for people who already own homes, right? And how that changes over time.
I think you could debate. I mean, it's an ongoing debate. It'll continue to be debated. I'm sure you can watch the YouTube comments that roll in after this, but I mean, the way that we measure shelter is certainly, or inflation is certainly debatable, right? I mean, like, go back over the last 10 years, for example, you know, the Bank of Canada was quote unquote struggling to hit their 2% target, right? Inflation was coming at 1.8, 1.9% every year. So we had to keep rates essentially at near zero. And, you know, over the last 10 years, like, Greater Vancouver and Toronto house prices have gone up, what, 10% a year for the last 10 years. So it's like, but you're telling me, you know, inflation was in check and shelter inflation was relatively subdued. So it's like, I'm struggling to say, like, I think anyone that lived in Vancouver or the GTA over the last 10 years would tell you that it felt like the cost of living was going up more than 2%.
Well, yeah. Year. And that's what John is saying about the counterintuitive, because the rates were so low, you could have this crazy price that you paid for a house, but your mortgage payments were low because the interest rates were low. And it gave this, I understand, I do agree with Steve in the sense, because they're measuring that way, there's a disconnect between the basic question of, if I had to buy a 2-bedroom house today versus 10 years ago, it feels like it costs a lot more for the same product, which is how we would normally think of inflation as a layperson. So it is a bit counterintuitive. But on the other hand, John, are you saying that, you know, maybe this look is a little more realistic at what households feel in terms of their pressures?
Yeah, I think that measure is. I mean, and going back to Steve's point about how the Bank of Canada reacts, interestingly, to if prices increase this year. I mean, it'd be interesting to see if they take that into account in their policy decisions, because they're not supposed to, obviously. They should be concerned about inflation. And you know, rising home prices is not the biggest variable for inflation. But the reality too, at the end of the day, is, I mean, it's going to be interesting over time, because, you know, trying to put a lid on home prices by keeping rates high is just going to drive up rents. You know what I mean? Like, there are so many pressures on prices now that it's going to be hard for the central bank to kind of try to keep a lid on that, right? You know, we were at just at an Urban Nation conference, and Urban Nation does a lot of analysis of pre-construction condos. And I think it was interesting because the president had, you know, I think he basically had a slide that says Toronto's long-term housing output in 3 headlines. And the first is builders are slashing launches. So they're taking inventory off the market. So they're not launching as many new projects. We're seeing a big slump in the construction of purpose-built rentals, and Canada's population is going to grow by 500,000 people per year by 2025, right? So it's like the first two are slashing supply, then we're driving up demand. And it's just going to put pressure, if not on prices, on rents, right? Because, I mean, what else is going to happen?
So before we change topics, I think, John, what you and Steve are highlighting is where is the long term and where is the short term? So Steve, I don't want to gloss over your great tweet. If this really is the bottom of the housing market, a second wave of inflation is a pretty good bet in 2024. Careful what you wish for. So I take Steve's point, like, is this the bottom? We also heard a lot of exuberance, people parsing through the Bank of Canada's wording around their last rate hike. Some people read a lot of dovish language into that. Some people read, no, I'm still watching. We're still watching, and we're on this inflation thing because that would be a mess for us to get that dreaded. Is it the Volcker bounce in the 80s where you thought you were fighting inflation? They had it under control. It came back worse. So I take Steve's point and yours as well, John, that I think the confusion is where's the short term, where's the long term? There's a real blending of the two, because some of the impacts that you were talking about, we would expect to see, let's say not maybe longest term, maybe midterm, where you start to see demand again outpacing supply. In the short term, Steve's point is very interesting. Like, you know, if we all get all exuberantly Canadian again and rush back in, you know, it is interesting. And I do wonder whether the bank is not just looking at their specific measures, but these knock-on effects of that housing wealth and how that feels in the economy. So that'll I think be something that we'll have to keep an eye on.
There's like two things there though to kind of keep a close eye on, which is so you had, I think today that we're recording this, it was like, you know, the US Fed's out there doing the rounds, you know, trying to sort of talk down markets. And so it was it's the Fed's Kashkari there. I'm not a huge fan of him, but he is one of the voting Fed officials. And so he was, you know, he's as quoted today saying, yes, the housing market is showing signs of rebounding in the United States, and that's going to make our job more difficult. So clearly, at least the Fed is watching the U.S. housing market. I thought the other interesting is, like, the day before we're recording this, the Reserve Bank of Australia was out. So last month they were out. The central bank says, okay, we're thinking we're probably going to pause rates here and just sort of let's see how they, you know, assess, similar to what the Bank of Canada did. They then came out yesterday and said, okay, actually, we're going to raise 25 basis points, and we actually think we need a few more rate hikes. So forget what we said in December, you know, because basically they found inflation has started to sort of tick back up, and wage growth has been sticky. So I don't know. I think the reality is like, you know, we can sit here and sort of pontificate till we're blue in the face, but I think anyone that has any like strong conviction on the outlook for the housing market over the next 12 months, I think is fooling themselves. I think it really depends on inflation, central banks, globally coordinated policy, and how this is all going to play out. And so, yeah, it's like, you know, to John's point, I mean, yeah, if the Bank of Canada truly has paused and inflation does continue to go down and it miraculously gets back to that 2% target and there's no second wave, then yeah, you might be seeing the bottom of the housing market. But if the inflation comes back, then I think all bets are off, right? So, and that's just too hard to say. It's too hard to predict.
So yeah, so we'll keep an eye on that. Interest rate corner will be back for some time, but there is a lot of mixed signals. We have the bond market on the one hand seeing a possible interest rate cut even towards the end of this year, which seems insane. I think we have friends of the show calling some of the opinions of bankers surveyed as indicating that alcohol and drug abuse is rife in the financial.
I think that was Ron.
I think that was Ron Butler saying that, you know, they must be high if they think that a rate coming down is possible in this year or next, and that there's a lot more of this inflationary fighting to come. So I think we'll just have to keep an eye on it. Are there any sort of last thoughts before maybe we talk about the fallout, more immediate, before we talk about what's next of these interest rates? And I'm talking about distressed sellers next. So we are now seeing some more anecdotal evidence about power of sales happening. And as I mentioned, I did have a great chat with Ron Butler, a longtime mortgage broker in the Toronto area, who's great on social media. And we had a great chat on Move Smartly about the segments of borrowers who are most at risk. And one segment that Ron pointed out was private lenders. These are people that do not have their mortgages with major banking institutions for the terms you normally see. They're people that probably struggle to get a mortgage for a reason and have 1 or 2 year mortgages with private lenders. And as Ron was pointing out, private lending is not an area that has a lot of the security of other types of lending. Private lenders can be as small as your mortgage broker or a lawyer giving you some funding, and all the way up to bigger companies doing this. But a lot of them now want to get out of the mortgage game because, we're seeing this shift. And so some people coming up to renew their mortgages are just hearing, nope, we're not offering this anymore. So these people then have to go and scramble and try to get mortgages elsewhere. So we saw a recent Globe and Mail headline here about that very thing, private lenders reining in real estate borrowers. Now, these people will scramble, as Ron said, but because most of these people probably went to private lending because they found it hard to qualify or get mortgages elsewhere, there is the question of whether this will result in an uptick in power sales. So far, I think it's still anecdotal. Would you guys agree? Are you seeing this on the ground in Toronto and Vancouver? Steve, maybe let's start with Vancouver.
Yeah, so everyone's like, source, what's your source? And it's like,
yes,
guys, it's like we do John and I do this day to day. We have a lot of contacts in the industry. You can't obviously disclose everything, but like, yeah, anecdotally, you chat with lawyers, you chat with people in the industry, and like, they're busy. Like, lawyers are like, yeah, we're receiving triple the normal amount of files that we would normally receive over the last couple of years. Now, obviously, we're coming off an extremely low base, so we don't have a flood of distressed sellers, but I think that it's picking up, and I think it's going to continue to ramp up. I mean, but I think there's a lot more to the story. I think the foreclosure process takes, definitely in Vancouver, BC, it takes a lot of time to play out. I don't know what else can I tell you. We just, even on the development side, there's a developer, let's call them, a land banker that has just filed for creditor protection. $1 billion in land holdings in the city here. So
wow,
this is it's coming. There's going to be people that you can't raise rates 400 basis points and just skate over this. Like, there's going to be people that are going to struggle, and there's going to be people that lose a lot of money, and we're certainly seeing anecdotal stories, and I think it's still very, very early days on that front. So despite sort of the noise and the headlines around January sales picking up and multiple offers, like, let's not forget there is still a lot of people, I think, that are struggling.
Steve, I wanted to ask you about that tweet. So you did mention that several large land bankers in Vancouver have filed for bankruptcy, unable to roll over their loans now that the music has stopped. And you went on to say these are offshore wannabe developers, overpaying for sites, taking out expensive debt, and refinancing every few years as land prices surge higher. It works until it doesn't. Now, I'm assuming large land bankers, like, are these again private lenders that were lending to people doing this sort of thing that are now taking their money back, or what's?
Yeah,
Can
pretty
you
much,
unpack
right?
that?
So yeah, these were like, a lot of these sites were like levered as much as they could. So the idea essentially has been, I mean, really over the last 10 years in particular, but let's just say over the last 5 years, right? Like, the reality is, like, development sites in Vancouver, you buy a piece of dirt every year, you don't have to build on it. Every year it goes up 10%. Okay, that's just basically what it's done. So the idea is that, they strap it with some debt. Every 12, 24 months, the value of the land goes up 10, 15, 20%. So you refinance, pull some equity out, go to a different lender, purchase another piece of land. And they're basically just like recycling cash. So similar to like the Burr method on single family houses that you hear about. This is basically what the developer was doing with land, with development sites. So they were just sitting on all these development sites, just rolling over their debt. And again, that helps too when, you know, the levels of interest rates continue to fall and prices go up. But when the reverse happens, which is rates go up and they go up very, very quickly, land prices fall at the same time. All of a sudden, you know, the lenders say, you know what, I don't want to refinance you. I don't want to extend you. So the musical chairs kind of comes to an end, and that's what we're seeing in this case. And like, I know there's more out there, and I'm sure we'll see more of them, I think, over the next 6 to 12 months.
Yeah, and I guess we're tracking like several different kinds of groups here. There's those that may try to sell to get out ahead of this. There's those that's even before you enter formal proceedings and foreclosure and all of that, and have to sell. So it will be interesting. Obviously, you know, I wonder if obviously, like if we see more of this on the construction side, on the builder developer side. I think in Toronto at Urban Nation's presentation earlier this morning, John, we heard only about one canceled condo project in Toronto so far in the first quarter. But all of this stuff has the potential to just keep adding to the supply gap that we're adding to, basically. If
Potential,
you know,
yeah. I mean, and the canceled project's one thing, it's going to take supply out. But I mean, when we think about kind of going back to your question about distress, you know, certainly we're going to see some among people who are completing this year. I think we've talked about that. And kind of going back to Steve's point that he kind of said earlier, I mean, and this is why he's right when he said, like, if we see another wave of inflation and rates stay high for longer, I mean, this is where like people can hang on for a while, do you know what I mean? And pay debt with debt or manage their increased payments for a certain period of time, you know, 6 months, 12 months. But once that gets stretched out over a longer period is when kind of all the cracks start revealing themselves and people, you know, are kind of pressured into selling or lose their property, their investment property. So I think this is, we're still early. And I think Steve's right. We're going to have to keep an eye out. Kind of some of these macro factors are going to probably ultimately kind of be the bigger driver of where the market's going. And inflation, of course, being one of them.
Yeah, so I think that's, sorry, go ahead, Steve.
Can I give you, I'll just give you like one more example. I like the anecdotes because it kind of just maybe helps people understand, you know, what you're seeing out there. And again, this isn't widespread, but like you're gonna see, like, you know, who's been swimming naked, right? So like I've seen a bunch of these recently. I'll give you one example. You know, East Vancouver, detached sort of old house, basically a building lot. Some guy buys it at the peak of the market for $2.2 million. Realistically, this house probably will rent for maybe $5,000. And so, you know, a year later, less than a year later, actually, it's back on the market. You know, started at 2.3, then back down to 2.2, now asking 2 million. House is maybe worth 1.8 at most today. They just overpaid at the top of the market. You know, you pull the title on this property and you see, okay, they've got a first loan with Home Capital Group for a 1-year term at 5.5%. Well, we know that new rate today is about 8.5%. And is there even enough equity in the properties? Home Capital going to refinance them at the time of the renewal, because the property's gone from 2.2 to about 1.8. So either this person's going to come up with a lot more equity, which they probably don't have, or they're going to try to go down the chain to a private lender, and the private lender's going to say, you don't have enough equity either. So these become like the forced sales. Again, they're not widespread, but these are the people that I think just speculated. They bought in at the top of the market and took on too much leverage, and you know, it's going to hurt.
Yeah, I mean, and Ron and I were talking about how I asked him about the numbers. He thought private lending was maybe 1 to 2% of the market share for mortgage products, but he mentioned they're very concentrated in Toronto and Greater Vancouver areas. So there could be specific areas. And you know, John, it's easy to talk about greed and people gambling, but the truth is, psychology studies in housing have shown that gamblers' excitement, which is really, really apparent in housing markets. So you hear your friend go out, do this, you feel like maybe you'll be able to do the same. So we're starting to hear some of those stories. And the question is, will we see a lot of this actually result in really low home prices?
Who's the guy that's protesting Mattamy Homes?
Oh,
That's
okay.
next.
The lawyer.
That's distressed buyers. We're talking about distressed sellers now. We're going to talk about distressed buyers, and it's happening too. But yes, it's the same thing. But to be fair, I think there is a sense of when this is all done, and again, this is short term versus long term, the people that are going to get dumped off that housing ladder, like, you know, are not just all speculators. There have been a lot of people who took the leap, tried to like grab onto the Canadian dream, and, you know, reached probably for some of these products, and will see themselves under a lot of pressure in this down cycle. Ron, you know, reminded me that, and reminded us that the degree to which this is happening is not something that we saw like in the United States in 2008. So if we're expecting, you know, wide, you know, swaths of streets being underpriced or going underwater, it's,
I mean, in his
not
numbers,
like
what did he say? 1 to 2% are private.
yes,
Yeah, so
and that while yeah.
So if you think about those numbers, that just means that the most vulnerable people, who are the ones who bought in the past year, you know, out of the 100,000+ sales, only 1 to 2,000 houses are private. Well, out of those, how many are actually going to be forced to sell? I don't know, 500, 600. Like, it's not like, I think people are expecting tens of thousands of people to default. And I agree with Ron. I don't think that's likely to happen, right?
Yeah, and before we move at that point, are power of sale homes always a good idea? Either of you?
No, I mean,
Ron was mentioning,
yeah,
that they're, you know, are they such a good deal if we do start to see these?
Yeah, Ron Butler did have a good thread on that. I mean, and in short, in Ontario at least, it's not the deal everyone thinks it is. I mean, the lenders, the banks have to try to maximize the sale price. They can't just take the lowball offer that you put in. They're usually as is condition, meaning there's no guarantees about the condition. Usually they're in rough shape. So listen, they're fine potential if you want to renovate a place, but it's not necessarily a deal.
All right, Steve, are you a
I think
power
you
of
tend to
sale
get,
hunter?
yeah, we don't have power of sale in BC. It's basically just essentially a foreclosure. So it takes a longer time for those to actually filter through to the actual market. I tend to find that I think you get decent deals. You know, it's not like, again, it's not like the US where you get these like fire sales at the court and, you know, lowest bidder gets it. It's they do have to market it and show they were able to achieve quote unquote fair market value. I tend to find that's, you know, 5%, maybe below what a normal listing would get. So yeah, there is a bit of savings there, but to John's point, there is a bit of risk because they're always sold as is where it is. So, you know, you could show up and there's no appliances, and it's unfortunate for you.
And let's demystify this a little bit. So am I wrong to think foreclosure process is the power sale process in Ontario, or explain to me the differences? And are banks usually behind these, and so they become the vendors of the property, trying to recoup, I guess, any of the mortgage capital that they invested in that house?
I think that's a longer discussion to go through foreclosures versus power of sales. Maybe we go over that next one.
Okay, fair enough. I think we should. Okay, so let's park that and let's end this month's talk with what Steve was talking about. So it's making a lot of headlines here in Toronto. Not going to say there's a lot of sympathy for this, but there is a group of buyers who have bought pre-construction. I believe they're all detached homes, correct, John?
I think so, yeah, Mattamy.
Pretty high price points. Mattamy Homes, a very well-known builder in Toronto area. And now these pre-con builders are buyers are finding themselves in a situation where they're waiting for these homes to close, to be finalized. And the builder, Mattamy themselves, are now selling the same models for lower prices. So some of these buyers, some of whom are lawyers themselves, and have signed the contracts saying that they have to purchase these homes at the prices they bought them at, are crying foul and asking the builders to stop doing this, or at least wait, I don't know, until the homes are built to do this. Now, I have known John long enough to know that this is one of the things that you've always pointed out as being one of the risks inherent in pre-con. For years and years and years, that risk paid off because people were making a lot of money. Now we're seeing the other side of that. Mm-hmm. That risk. So I guess just some closing thoughts, John, on what you think about this situation. And then Steve, I think in Vancouver, there have been some protests too. So I want to get your thoughts on the same.
I mean, it's complete nonsense. I mean, the reality is, I mean, you're making a financial investment. I mean, you can't protest. I mean, you can't protest when you're on the wrong side of that bet, right? It just doesn't work like that. And their idea that they're going to tell Mattamy what to do with their existing units. I mean, quite frankly, it doesn't matter what Mattamy does because the resale prices have declined. Like their appraised values are lower anyways. So, you know, a lot of these people were investments. I mean, the one main person in that article, I think, was a lawyer who bought $2.5 million homes, right?
I mean, the sympathy is a little bit constrained.
Exactly. So you know what, like if you want to make that bet, you better have the money to do it. If not, default. And I feel sad for you, but listen, you can't max out on leverage during a housing bubble and be shocked when that bet doesn't play out. You take responsibility for your actions, unfortunately. So I don't have a lot of sympathy for them. Listen, it's not great when people lose money, but I wasn't making those crazy speculative investments. You know what I mean? And and the fact is, I would not have made a ton of money if those bets paid off either, right? So there are two sides to that. So, you know, they can't just be celebrating when they make money and then be pissed off when they lose money. That's my 2 cents.
Yeah, I think this is the problem though, is you get into these you know, 20+ year bull markets where the government has come in at every downturn and pulled a policy lever to support housing that people feel like it's a, you know, a government guaranteed backstop. And, you know, it sort of creates this behavior, right? And it's sort of these speculative feedback loops that, you know, I think we've cautioned for, John, you and I have cautioned for years. I remember during the onset of the pandemic, right? It was like the mortgage deferrals. And it's like, well, you know, it was probably a policy that you needed, but there is a consequence of that, which is, you know, people felt like they could just continue to speculate because, you know, no matter what, the government would always have your back and it wouldn't let house prices fall. And so, you know, that I think certainly has created a lot of this mentality. So I mean, my honest opinion is I actually think, as difficult as it is, and someone that, you know, earns a profession in this industry, there's a lot of times where I'm like, we genuinely need a good cleansing to get rid of this bad speculative behavior and this mentality. So, you know, I don't know. I just
but I don't even think this is going to get rid of the speculative behavior. I don't think so. I think the speculation and the confidence is still there for the people who are not the Mattamy home buyers. Everyone else still wants to buy real estate, like a lot of people.
And I agree, and maybe it doesn't change, but I understand like the other side of the argument, which is I understand why people want rates to be higher for longer, and like they want the Bank of Canada to keep going, and like I think people generally want things to flush out a bit, and so yeah, it's interesting. I understand both arguments, and I think you know, there's certainly a very valid argument that a good cleansing is needed, and that's why I said, you know, to go back to the beginning of the show, it's like I genuinely get concerned that, you know, if this is, you know, truly getting, you know, the bottom, and you know, I think the Bank of Canada should hold rates higher for longer if, in fact, house prices actually start accelerating higher. Whether they do or not is anyone's guess, but
look at this. Steve Saretsky advocating is against his own interest.
He's on it. All right.
I mean, there's some truth to that.
Commenters, there's some honesty there. I mean, I have to be honest. I mean, we're going to keep tracking this. I really liked Steve's analogy of musical chairs, and like music's done and like a few people are getting caught out and don't have a chair. My concern is the other vision I have is like of a carousel, where everyone's like, oh, okay, I'll just sit on this thing. And then soon enough, the carousel just starts speeding up again, which we have seen again and again. And, you know, when you talk about a cleansing, I mean, we're using all these words, like what are people hoping for? I mean, a lot of people are very worried overall about the housing market, the prices. The feeling is some of this speculative activity that has been responsible for some of the increased prices, you know, gets cut back,
Mhm.
that would be good in general. It would add some stability. We're not seeing as crazy year-over-year increases in terms of house prices because of speculation. The problem is, I feel like, I don't know, I have a lot of doubt about how Canada is now tethered to this cycle. I will be interested to see, if confidence returns, what will the bank do, and what will we see next in terms of, will they take on board these concerns that maybe they're already seeing in the US, but okay, we're back onto this inflationary go around. So I guess keep tuned in.
Let the market clear. I mean, I don't know, like all the government keeps coming in with like all these policy changes, empty homes tax, speculation tax, foreign buyer ban, Just let the market clear. It'll do the market will do the work for you. But like I said, I know government's had their hand in the cookie jar for the last several decades, and it's certainly created a lot of this reinforcing feedback loops of higher prices and speculative activity. So like I said, I think rates, I think there's still more pain to come in the background. And so it'll be interesting to see, how the next couple months shape up, because that'll be telling.
Yeah, I think so too.
All right. So let it run, Steve Saretsky. Let the pain run. All right, we're going to end on that note. Thank you, both of you, for a really actually great discussion around several things, several different points of view, and that makes sense because the market's always, very, very confusing right now. And to all of you, please keep your questions and comments coming. Try to stick to constructive comments about real estate. At John Fasalis on Twitter, at Steve Saretsky on Twitter. I'm at Move Smartly on Twitter. You can also email me at editor@movesmartly.com. Give us all your comments below this video as well. We enjoy hearing from you. And we will see you next month.